Welcome to The Weekly Trend, a podcast for navigating the markets through the lens of technical analysis. The Weekly Trend podcast is provided for educational purposes only and does not constitute any professional advice. Listeners should not act upon the information or content without first seeking advice from a registered financial planner.
Welcome back to the Weekly Trend podcast. Today is Friday, July 29th, 2022. S&P 500 currently sitting at 4,111. I'm David Zarling. I'm here with Ian Isaac Newton McMillan. Plenty to cover this week, between the definition of a recession to earnings, price action, you name it. You guys did a great job covering last week. Where do you want to start this week?
Yeah, so a pretty good week for stocks overall. If we were to close, here today, we'd be going out at the highs of the day, highs of the week. So the momentum from last week certainly continues, and this goes back to, for multiple podcasts, why I won't totally speak for Dave. We're not the most bullish. Don't have the most bullish outlook longer term for the market, but we have said that we would most likely see the biggest rally yet, and that continues to come to fruition.
Yeah, for sure. No, counter trend rallies are a thing, and when we look
this one has had the best breadth.
Yes, but we've seen breadth expansion in other. So when we look at, because we're market historians, right? We look at previous markets. We look at the 70s and we look at the 2000s on protracted bear markets, ones that last more than just a few months. These periods of breadth expansion, counter trend moves that can be in the 20 to 30% are a real thing. I want to be careful what I'm saying. That doesn't mean that we believe that this is a counter trend move factually. Like, for sure, that's what this is. We have no idea. This is what other counter trend moves have looked like in protracted bear markets. And while constructive, right, seeing some breadth thrust is constructive, doesn't mean we're out of the woods. Is that a fair assessment?
Absolutely. And there's still a lot of areas that haven't, like I pointed out, JP Morgan hasn't really. There's some good things, but still overall a lot of mixed signals.
Actually talk about that, because you did have a good tweet about that. Can you give the context for the listeners what you mean by, and maybe we can just compare S&P versus JP Morgan over the past few
I would
weeks.
say they're pretty highly correlated. It's one of the stocks that, if a market's going to do something, if a market is healthy, if a market's going to be in an uptrend for the most part, I'm not saying they have to necessarily outperform. Right. That you need to see JP Morgan outperform. But it's kind of a bellwether, and one of those where, financials are important to seeing a continued uptrend. And we've seen some banks do well, particularly more regionals. But JP Morgan just still hanging out here at 115. You've got broad indices that have moved well through their, I think all the indices at this point have moved through their June 10th gaps. And JP Morgan really, I guess it technically filled its gap down from June 13th. But
you're just saying that
from a technical perspective, it has not participated.
Right. It's not participating in the same direction counter trend wise as the broad. When we say broad, let's use something like S&P, and that may not be a most appropriate way to account for broad, but S&P 500 has moved a lot more aggressively to the upside than JP Morgan. And your point is, JP Morgan being the largest financial institution in the United States, if this is how that stock is going to behave, it's one of those things where it perks your interest, because, like you said, it doesn't need to outperform, but if it's not going to participate, how bullish are things?
Exactly.
And so, Ian, where is this strength coming from? When we see the S&P 500 do something like it's doing the past week or so, more than 1 week. But where's this coming from? Where's the strength?
Apple, I mean, kind of your larger cap growthier names. Some, semiconductors have held up well. Transports have been strong. There's been solid participation from, a good amount of areas, I guess you can say. Energy continues to hold in there. Solar, obviously, probably, the solar not a huge part of the S&P, but has certainly been an outperformer.
So yeah, can you walk through the relative strength aspect of that? So we kind of talked about JP Morgan. Yes, it's up a little bit over the past few weeks, but not to the degree that we're seeing happen at the S&P 500 level. So lack of participation, but you're talking about relative strength out of something like clean energy.
Yeah.
How do we identify that as technicians? How are we even able to say something like that to people listening who aren't technicians?
Use the ratio of, comparing one asset to another. One is the denominator, one is the numerator.
So you're taking something like, it could be TAN, or ICLEAN, ICLN, like clean energy versus the S&P, and you're dividing that by the S&P 500, and that ratio shows you one is outperforming the other, and pretty aggressively.
Yep. Absolutely. And if you have a benchmark, you need to be comparing things you own to your benchmark to ensure that they're in relative uptrends.
Yeah. Trends be trends. And when they're going from lower left to upper right, that's not a bad thing. And so we see some relative strength out of clean energy, not so much out of some of the big financial names like JP Morgan. So a little bit of a mixed bag. Where else are you seeing relative strength or relative weakness that give you any type of thesis or confirmation of a thesis, those type of things?
Well, so we talked about how last week or 2 weeks we lost one of our big areas that everyone was excited about, China. That gap down 4% today. So that continues to be a loss. Another one that it was an earlier leader, hasn't done anything for 3 weeks now, 4 weeks, is biotech. Now, could it be building a that one's probably not as rough looking as China.
But it's a consolidation that's happening below important horizontal levels. And what I mean by horizontal levels is just where supply and demand have interacted more frequently in the past. And it's happening below a declining 200-day moving average.
And it hasn't broken its rate of trend, going back to those September 2021 highs.
With the rate of trend being down in that, same with China. And you brought up China, and that's really interesting when you think about emerging markets overall. It's the largest piece of that. On the flip side, you have something like Brazil and Latin America on a relative basis actually moving higher.
Brazil with a failed breakdown?
Yeah, if you look at Brazil on an absolute basis.
EWZ below 26 and now back above, or 27, whatever you want to call it in there.
And I know everybody, since 2 or 3 podcasts ago where you pointed out the Bovespa has been tracking it, is now above that 10,000 level. So they're, like you said, both priced in dollars and priced in the Brazilian real. Brazilian stocks are now above previous, support that you would have expected potentially to turn into resistance, and it's not. We call that a false breakdown. So you have strength out of Latin America, but weakness out of China, which in the emerging market world, if you just look at emerging markets as its own thing, because China is so much more heavily weighted, that's a weighting issue. That's why emerging markets don't look so hot anymore. Or they haven't looked hot, but they're maybe even looking worse.
I agree. And India's had a nice strong rally. It's up above its June highs. But again, lots of things coming into rates of trend. I could throw semiconductors into that category too.
And I think it's worth noting, just because I looked at the chart just now, because of the discussion on Brazil, China, India, emerging markets as a whole using something like EM versus the S&P going out at new relative lows as we speak. And that's that factor of just understanding weighting. So internationally, we don't necessarily have some good things going on. There's still some weakness elsewhere, but we are seeing domestically in the U.S. some bullish breadth thrusts. And when
there's been some solid stuff out there.
And can you kind of walk through, for those who might be new to that, like when I say breadth thrust, what do I mean? Like, and there's different measurements.
It's a spike in participation.
Yeah, I love it. That's a great summary.
Spike in participation, a very large spike. I mean, it could be one day, it could be
to the upside. Yeah.
No, if you have a 95% up day, that's a thrust. Or if you had like 2 or 3 80% up days, that could be. I mean, there's so many things. Before we hopped on here, you had brought up the bullish percent index, right?
Yeah.
It's moved back above this 30 level, which can be a bottoming area. Was in 15 and 16, 2011.
Well, it's a really unique thing, because when you talk about bullish percent, and this goes back to things we've talked about in the past, is the difference between a bottom and the bottom. And of course, we never know these things until afterwards. But there are times in the past in longer term bear markets where you get these moves out of bullish percent out of the 30s, but it eventually resolves lower. So it falls in that counter trend move. So, but if this is the bottom, this is what you would expect to see. But a bottom also looks like this. So it's not as easy as saying this is the bottom, because sometimes in longer term bear markets, this is what this kind of looks like. You have some of these breadth thrusts going on. And so you got to use price. And so if we are to use price, if we use something like the S&P 500 in what you look at from a supply and demand dynamic, what are some levels there that would be important for listeners and clients to think about?
Yeah, I still think this 4150 is probably, I mean, that's got so many points, so many touch points. It was obviously a huge level back in late May, early June. We are sitting, right now as we speak, dead smack in the middle of that consolidation at, 4115-ish, 4120-ish.
And that's a huge level, because so we broke that level in May, which was a huge behavioral level going all the way back to April of 2021. And we consolidated. Ian's painting the picture of this consolidation that took place in late May to early June. That took quite a few days to develop, that we broke down from pretty aggressively, and we're back there now. It's going to be really important information to see which way buyers or sellers take this from this point forward, right? That 4140, 4150 that you were talking about. If they can plow through that, that's pretty bullish. But if they can't, that probably signals additional distribution by sellers and further downside ahead. Is that a fair description of our current situation? Mm-hmm. So we do have an expansion of breadth. We can look at things like bullish percent. We can look at new highs versus new lows. Anything we're seeing from that, new highs versus new lows?
I think yesterday we did get, I want to say we were plus 12 yesterday.
And and if we were positive, that's one of the first times we've been.
I mean, that's the edit. So it's the first time since we were positive Take that back. We were not. July 28th, -6. So we have yet to put in. Now, again, we're showing we would be positive today, but we'll see where this data comes in. It's a little bit better later in the evenings. Still haven't had a positive day since June 8th.
Wow.
And those were pretty minimal. We had a nice little run there of like a couple weeks of positive. I mean, they were, in the 20 to 30 net positive range, net new highs.
Right. And so there's lots of different measurements, and it's even paying attention to what's going on with client portfolios. And what do I mean by that is we have this data that we track, but you also have anecdotal information. And I guess the way I would equate this to is, you got your weather app, you look at it, it says it's supposed to storm, but until you see the rain outside your window, you're not really confirming that storm is here, or lightning or thunder, any of those things. And vice versa, if it's calling for sunshine, but outside your window it's raining, well, we have the real data in front of us. There's been some individual positions that have started to work that, and in setups that haven't in the past, meaning a new breakout during this whole bear market regime, you take a breakout and it would fail. We're starting to see some things stick. Is that I think you highlighted that earlier today.
I mean, I would say the breakouts on individual names are holding better than they have been, again, on the previous rallies we've seen in this downtrend.
That's a good way to put it. There's been rallies in this downtrend where breakouts had failed, and now we're starting to see breakouts stick.
Yeah, and we're getting like more than being green for just 2 days in a row. You're seeing intraday recoveries. In fact, a few of the names we own, both yesterday and today, have been red to start the session and have slowly been bid up throughout the day and into the close. Obviously, we got 2 hours to go today, but it seems to be constructive. I'm not totally convinced, obviously, for the many things that we've kind of laid out previously, but this is what it would look like.
Yeah. And there's a long way to go before
Apple's going to new relative highs today.
Yeah.
That's really hard. And Apple back above a 200, a 200 day that never even rolled over. I'm not saying it's fun, but it is what it is.
It's really hard
Microsoft can do this. And
for the broad market to roll over on a big picture basis without Apple. We've talked about that numerous times, going into the 07 to 08 market top, financials were the leader. And then we saw things break down that were the bigger players in financials, and we're not necessarily seeing that from Apple yet. However, we've seen it from Amazon, we've seen it from Google, we've seen it from Meta, previously Facebook. There are bigger cap tech names, and tech is what's led this rally. And when I say rally, I mean big picture. From back in 09, it's been tech. And we've seen those on a relative basis fail. But until Apple fails, it's really hard to bring down the market further than what it has already. And Microsoft is just holding a rate of trend that those two together, I believe, are like 11% of the S&P 500, which is a number we haven't seen in the past. But until you bring down that piece, it's really hard to see the market correct any further than it has.
Yeah, and you've got ARK not really doing much.
So ARK being ARK Innovation, which is kind of a poster child for some of the high-flying growth stocks that aren't big. They're not like, now there's some Tesla that's owned in there. But from a capitalization standpoint, ARK isn't owning huge mega cap tech. It's owning high growth tech, which doesn't have the same capitalization. And your point is, it's a mixed bag. On the one hand, you have Microsoft and Apple holding up on a relative basis, but on the flip side, the high growth, high tech names are not. They are not confirming this. Is that?
Yes, I would agree. And some are. Again, it goes back to this, it's a thrust. Are you seeing the participation you'd like to see? I guess. But then the levels, right? We talked about transports before hopping on here. You've taken out some intermediate term levels, but have you taken out some larger necklines?
Transports, you're using something like IYT?
Yeah.
Yeah. So, okay, actually, that's a really good one you bring up. So when we look at transports, and as you guys know from listening in the past, transports are one of those economically cyclical sensitive areas, similar to the semiconductors. Both of them transport things in different ways. Obviously, semiconductors transport data digitally, things that are virtual. Transports transport things that are literal and like actually exist physically. So they're important to track. And Ian's point about transports is it's a mixed bag in the sense of you look at something like IYT that is testing had tested a 207 level, which was prior highs. Buyers showed up and supported that, but it's definitely not in the clear until it clears 245. And if transports are going to be weak, and this is just a counter trend rally, transports are not giving the all clear.
No.
We're in this mixed bag scenario of, yes, we have breadth thrust. Yes, you see your big cap names like Apple and Microsoft holding up. So it's not the death knell yet.
But then, look at Facebook's horrible.
Yeah, that one is bad.
Or Meta, whatever it's.
No, that is a mess. That's a hot mess, hands off type scenario. You look at social stocks overall.
New relative lows, I believe. Didn't you mention that earlier this week?
Yeah, new relative lows. And so you've got this scenario of portfolio construction of emerging markets, new relative lows versus the S&P 500. If you look at something more broadly like VEU, which is a representation, it's the Vanguard FTSE All World, subtracts out U.S. stocks, and you look at that on a relative basis, that's also going out at relative new lows. And so portfolio construction is important because if you're blindly holding international stocks, you're now underperforming U.S. stocks, but Microsoft and Apple are holding up. At the same time, we have high growth names that would happen inside of ARC Innovation still struggling on a relative basis. It's really pivoted into these big cap names again. As far as any type of alpha or any type of performance, it's in the last few weeks, it's pivoted into these big cap, let's call it mega cap names. And so we're seeing some breadth, but it's really breadth on a counter trend type move.
Yeah,
and
it looks good.
Yeah, it's fair if it's a bottom or the bottom.
Yeah.
That's fine. And I think from the S&P 500, this level that you talked about, this 4150, 4170, until we clear that, you still have a sequence of lower highs, lower lows. And if it gets above that, that's fine. We can get more aggressive. There's no problem there.
You got things like copper that are going, copper's had it's going to have a nice big weekly candle. But I sit there and I look at the big picture, as you like to say, and it's still a neckline. There's a neckline up here at $4 that, you could rally another 15% in copper. Come into a rate of trend from the top, not fix anything.
Right. And that's what makes counter trend rallies so hard, is because for some, they feel like relief. For some, they feel like the bottom when they could just be a bottom until the next bottom is made.
Industrial metals in general having a decent week. That'll be interesting to see where this goes. And it's really been the last few days. But steel, nickel's having a good day. Maybe it's a return to that Q1 trade.
Where it's you're talking about commodities, industrial metals, and energy.
Yeah.
And that's a good point that you brought up, is we haven't seen energy doing well for a little while here. But yeah, we have the big boys like ExxonMobil and Chevron really having great weeks. Chevron, for example, testing an absolute level that goes back.
And crude hasn't had a massive move itself. It's pretty full. Crude's at the same spot it was 3 weeks ago, around this 97, 98.
Yeah, that's a fascinating situation with oil, only because when you look at it, as Ian is talking about on an absolute basis, really, really important level at this $98. If we can't sustain above that level, that probably means crude's heading lower, and how well our energy stocks doing in that type of environment. Time will tell. So we've talked a lot about equities, almost exclusively. What about fixed income, bonds, crypto? Talked a little bit about commodities.
Yeah, I mean, good week. A good week out, or I should say, a good recovery out of bonds. They're not going to close too much higher than last week's close, but and rates continue to look like they want to roll over. To me, like if I pull up a 30-year Treasury chart, it looks like we're knocking on the door there at 2.9, and you could go down to 2.6, 2.5s. 10 years a little bit cleaner. That's more of a clean horizontal break there at 2.7.
Yeah, 2.75, somewhere in there. Clean break.
That takes you down potentially to.
Well, on weaker rates means higher bonds, and that's fine because it's been really interesting to watch bonds correct almost as much as equities since the beginning of the year, which is why those 60-40 portfolios have really struggled. And do bonds get a big bid here? We haven't talked too much about the dollar, but the dollar has definitely paused, still above its breakout level. Do we see a trade-weighted dollar move higher? And that's the thesis, and that thesis continues to be confirmed until we close below 104 on a trade-weighted basis. And so we'll see. We'll see over time where we fit in the dollar bond scenario. The topic du jour was the euro being at parity versus the US dollar, just for the past 2 weeks. And here we're at $1 and 2 pennies in that relationship, but definitely still broken important horizontal levels for a currency perspective. What about from a volatility perspective, using something like the CBOE VIX?
Continues to move lower. I would say it's broken a rate of trend. Some people say you can't do technical. It's a rate of trend. I'm sorry. It's got like 6 or 7 touches.
Right.
I'm throwing that in the rate of trend category, and it looks like it's been broken to me.
Yeah. And so the rate of trend currently, before market close on Friday, July 29, 2022, it's broken that rate of trend. Now, we'll see where we are by the end of the day. But your point is, this is a rate of trend and implied volatility that goes back to November 2021. That's breaking down. That would suggest a continued melt up in equity prices, because typically lower volatility means higher equity prices. That's not always the case. And so do we see a scenario where we continue to rally higher as volatility cools off? Or is this a type of bottom that gets established in volatility and we start to see an acceleration to the downside? Time will tell. So we've kind of bumped up towards the end of our client portion of the podcast. And one thing I wanted to highlight is just the work of our team. And, Kevin Ferrari, congratulations to him for passing the CMT3 exam. And now he goes, it's huge, right?
Yeah.
And now he goes through the charter process, getting some sponsors. I have a lot of respect for the way the charter market technician charter is established and given. It's not just handed out lightly. You have to pass these 3 rigorous tests. Then you have to pass some examinations by your peers, have some experience in the industry. And so I'm super proud of Kevin. I know you are too, Ian, and you're a huge proponent. And now we've got a team in the trenches that's establishing their expertise in supply and demand. And that makes me excited, because there's not necessarily a lot of registered investment advisors out there that carry that type of gravitas when it involves being technicians. And here we are. We got dudes like you, Dan and Kevin that understand price, how to study it, how to diagnose it visually. It's a big deal for our clients, and it makes me super proud.
Yeah, I'm super stoked. Not a lot of firms out there that do what we do with 4 CMTs, so very unique.
Well, and you're a big part of that, Ian. I know how you publicly push, and are a proponent for the study of this valuation metric. That we're not sitting here studying thousands and thousands of balance sheets. We're actually studying the opinions of thousands and thousands of investors, whether they're retail or institutional, using price to manage our risk and reward for our clients. And that's a benefit to our clients. And so I thank you for that. Thank the Adaptive team. And we're going to talk weekly and monthly candles, some value weighted average price, maybe McClellan oscillator in the extended portion of the podcast. So I hope you guys stay on for that. But if you don't, we hope you guys enjoyed this one, and we'll do it again next week.
Have a great weekend, everyone.
All right, Ian, heading into the extended portion of the podcast, one thing that, we've never asked for from our listeners before, and we get a lot of good feedback, a lot of people that listen to this, but you brought this up earlier today, is should we be asking people to like this podcast and give it some stars?
I think we should.
I think we should too. And so if you like this, whatever platform you're on, whatever your rating is, please give us a like. Please give us feedback.
A 5-star rating.
Yeah, 5-star rating. That helps us out. That helps us get expertise out to others. It's that we've never asked for that before. I don't know why we waited till now.
Yeah, I don't know. I mean, we've been doing this for almost 2.5, 3 years.
Yeah. And maybe that gives you a little insight into our attitude towards things, but I think it's okay to ask for it now. But it's really about providing you guys great information, and we would really appreciate the reciprocation and giving us high rankings, giving us 5 stars on whatever platform you're listening to. That would mean a lot to us and helps us get it out to more individuals. And so, Ian, thank you for pointing that out. Much appreciated. And now let's talk about it being July 29th.
July 29th. Oh my gosh. We've already completed 7 out of 12 months.
I know. It's wild. Not only is it Justin's birthday, happy birthday, Justin, but it's also, we get weekly and monthly candles. Like you said, it kind of feels like the year accelerates as we get through July and head into August. We've talked about, I'm going to ad lib a little bit here, seasonality in the past, and I feel like for the last 4 weeks we've talked about the possibility of seasonal strength into mid-August. We've seen that. We're ending August, but this is also a time to examine some weekly and monthly price candles.
Yeah, I mean, they don't look bad for the most part. The major indices, again, I mean, NASDAQ getting follow through, not necessarily through every single, NASDAQ actually gonna maybe close above its June, May, or late May, early June consolidation. That's the same one we mentioned earlier on the S&P.
Above 310, right?
Yep.
Above 310 would be an important close for the Qs. And that fits what we're seeing from a broader perspective, meaning if you want to look at a large cap versus small cap, mega cap, those type of things, we're seeing that strength out of the mega cap names, Qs being a good representation of that. And like you pointed out, closing above 310, pretty important level on the Qs. Maybe that's it. Maybe that was the bottom, and we move higher from here. And
I'm willing to accept that. I mean, bulls seem to be in control short term. So, are people just exhausted from selling? Are people exhausted in general, just on the way the last 18 months has played out?
Right.
I would put myself in that category. I mean, obviously still here participating, but wouldn't that be just like the market to catch everyone off guard? Everyone's worn out. Okay. Yep. Then we get into Q2 and we've got pretty much all the evidence we need that says the market's going lower. So, everyone sees, okay, finally we got this light at the end of the tunnel. I can position myself to be bearish because clearly we are going into recession, which that's a whole.
Yeah, let's talk about that. What do you mean, Ian?
I don't even know what a recession is. And I asked, Kate and I had this conversation last night. So my wife, she works in marketing. She never took any business school classes. She doesn't really get involved in business or, what's going on in the economy. But even she knew that the most standard baseline definition is 2 negative quarters. That's whatever Mr. PhD economist wants to say, I don't care.
2 negative quarters of GDP, right?
2 negative quarters of GDP. And whether it leads to a multi-month bear market or not really isn't what I find comical. It's the fact that all of a sudden we've decided to change this definition.
Yeah. No, and isn't that classic? On this show, numerous times we point out that the media does not have your best interest in mind. And I think it's fair to say that when you have governments redefining what a recession is, that maybe they don't have your best interest in mind. And so here we live in a world where those with the loudest voices, media, don't have your best interest in mind, and those governing authorities sometimes don't have your best interest in mind. That's kind of a precarious situation.
It is.
And thank goodness we don't get paid in GDP. We get paid in price. And what I mean by that is when we execute risk and reward scenarios on behalf of our clients, it's not because of GDP. Because if people are going to lie about GDP, that's kind of a big deal. And prices, it is what it is when you get into the marketplace. And I know it bothers some technicians when you say price is truth, but it's really what trades get executed in. And
then there's the argument because they're like, well, it wasn't the truth 2 months ago when it was at a different price. Yeah, truth can change. Truth can change every day.
Right. And especially in markets. And that's where, rather than using GDP that is defined in the wind, always changing, we'll just use price because that's what's on the screen today. And it's a future discounting mechanism. And wouldn't you know it, seeing indexes down anywhere from 20 to 40%. And now we're talking about negative GDP. I mean, this is something we were talking about back in January.
Is this just another it's been priced in?
Correct.
Everyone knew. Everyone and their mother knew a recession was coming. So is it, okay, that's what we've spent the last 18 months working on across the market.
Yeah, and that's just it. Like everybody and their mother knows about a recession today, but they weren't talking about it in January. But you know what was talking about?
They weren't talking about it last April or March or February.
No, but the market was talking about it.
The actual average stock started going down.
Yeah, when the average retail account is down 34, 35% going into this end of July. And I'm not talking about adaptive accounts. I'm just talking about when we study what's going on in retail.
Yeah.
When those are down that much, that's discounting something. They weren't talking about the definition of GDP back in December. Why? Because no one thought a recession was possible. But here we are. Now we're mincing words about what GDP is or what a recession is. Not what GDP is, but what a recession is. And I would also argue we just had another 70 basis point rate hike.
Yeah, 75.
But you just highlighted before.
Rates are rolling over.
Rates are rolling over. So is the market now dictating that we're going to be cutting rates before anybody could possibly imagine? Imagine that. Imagine markets knowing something before an individual does. That bothers people.
Right. And you say, this goes back to your point of people don't like this whole price is truth thing. And to me, it goes back to, you can sit there and say, oh, this stock is worth X because I took whatever data, historical data, and I extrapolated it forward. I mean, and maybe all that's true, but it's not worth that, right? It's not worth that. Maybe it's worth that in the future, but it is not worth that. If you say a stock is worth 140 and it's sitting at 100, then the stock is worth $100. I mean, this is one of the most free market games out there where everyone gets to have their opinion.
And it's transparent.
And It's
And
sorry,
it's not
the market. We got a lot of people out here. We have enough liquidity out here, people on both sides of the table, and it says your stock's not worth that. Sorry that your 40 hours of research into this stock is not worth anything.
Right. And it goes back to GDP is revised, earnings are revised. Do you know what? When we exited energy back in early June and were able to mitigate and reduce and avoid the correction in energy, they didn't go back and revise the price of
too.
Well, yeah, and correct, we shorted it. They didn't go back and revise the price of our transactions. Thank goodness. But all this other economic data gets revised. Imagine that. Imagine you execute a trade and they come back later and be like, you know that trade you made in June? It's actually worth X. No, price is price. It's executed in real time. That's what you get paid in. That's what we're dealing with. These revised economic numbers, whether it's non-farm payrolls, GDP, whatever you want to name it, they all get revised. Like we'll be a year from now and they're still going to be revising the GDP for this quarter. Think about that. Think about making your decisions based on that. To me, that's insanity. Like, why would you base your decision on something a number that's going to be revised a year later? So you actually don't really know what that number is. But we get priced today. Thank goodness we get priced today. And we can operate based off of that. Sorry, we got a little fired up there. It's okay.
Good.
So weekly and monthly candles, some positive developments, appears to be a type of bottom. We don't know if it's the bottom. I think you highlighted something earlier that's worth talking about, and that's Apple. And it's why I called you Isaac Newton at the start.
I mean, we talked about this below 150. I mean, I said back in May when it broke down, Apple below 156 is going to be hard for the market to rally as long as this is below this level. And we're back above that level. So got to be honest with yourself, right?
Right. It's really hard for the market to correct further without Apple's historically, like when we study markets and we look back, historically significant part of this current market environment. What I mean by that is there's not many times where a stock is worth 7% of its index, which is where Apple is right now. That's historically significant.
And 7% doesn't sound like right. Like there's, lots of people will hold 10 positions at 10% each.
Yeah.
So yeah, Dave's point is when we're talking about an index that includes 500 stocks.
Yeah.
So the average weighting is 20 bips and you've got a stock at 700 bips.
Yeah, it's huge.
Yeah, it has an outweighted impact.
It has an outweighted impact. And here we have Apple above its average volume weighted price going back to the highs in January. It's back above that. At the same time, it's what we like to call kissing the backside of its broken rate of trend. So the rate of trend that I'm talking about goes from July of 2020. And when we connect the lows going back in time, if you're a technician, you pull up a chart and you look at Apple and you go back to July 2020, you connect the lows. We broke that rate of trend back in May of this year. And now we're going and testing that rate of trend just above a VWAP from the highs. Now, I don't know how this turns out, but Ian's point is until on a relative basis it leads to the downside, it's going to be really hard for this to turn into a big bear market.
Yeah, exactly. And same with Microsoft.
Yeah, Microsoft. You posted a really good chart of that.
7-year uptrend, and it's coming to, if you were going to ask for a consolidation and not a massive sell-off in a stock like this, kind of got what you wanted. Now, is it off? Now, we did have a 30% drawdown. So maybe someone call that a consolidation. But I would say long-term behavior, zooming out, you kind of got a soft landing back into this rate of trend that we've seen since, literally, 7 months. August 2015, this trend started. Well, this particular rate of trend.
Yeah, you're just talking about
connecting these lows in here.
Yeah. And what's interesting is Microsoft, to me, Well, I don't even know if I can say to me because the chart's the chart, so it's not really about me. But Microsoft at this 280 level, super important. If you're looking at a Microsoft chart, they bought Microsoft in October of 21. Buyer stepped up again in January, again in February, again in March, and then it failed in May at 280. And here we are at 280 again. This is going to be really important what happens next week, in my opinion.
And look at that Microsoft relative chart. I mean, we're back to the scene of the crime where it's been rejected.
Yeah.
The last 5 times here.
Yep.
Same level as July 20 highs. Is this building a base to go higher? Is this are they just keeping these things propped up until the final, final waterfall?
So I'm going to throw at you a little bit of a curveball.
Ooh, okay.
Okay. So, and this goes down the bullish thesis. So when you look at Amazon and you pull up a chart at Amazon, do we have on a daily time frame one of the biggest island reversals you've ever seen?
Yeah, it's pretty big, isn't it? Back up above. I mean, it's essentially, like that 135-ish. I mean, it's the essence. It is absolutely the essence of an island reversal.
Yeah, like this consolidation that took place from May of 2022 of this year through now, and we gap right over that, and we leave this island of price here. That gets really interesting if that holds.
And that's 3 months of price. And that was all April, right? That's end of April through today, yesterday.
Mm-hmm. And so if we leave that all behind and you've got Apple going out at new relative highs and you got Amazon doing something like this, you could see the market move pretty aggressively higher. I'm not saying we're out of the woods, but those two stocks alone, that's kind of a big deal.
It is a big deal.
I mean, and you already brought up Microsoft. So Amazon, Microsoft, and Apple, you're talking about almost 17% of the whole S&P 500.
Well, and then you had this failed move in Google, which I guess could still go lower, but it looked primed to, move out of this consolidation, take another leg down, and has saved itself over the last 3 days.
That's a great point. And Google is no surprise. It's almost 4%. So let's walk this through. Amazon, Microsoft, Amazon, Google. We just talked about those all having now what appear to be positive characteristics taking place. And those are upwards of 1/5 of the whole index. And then you throw in things like Tesla, which had a consolidation that would have had it broken down, would have confirmed that broke upwards. So this appears to be another leg in the mega cap growth thesis that confirms that those type of stocks move higher.
Yes.
So the Amazon island, to me, that's a big one.
That's a great point.
Like we're going to see Amazon.
I'll be staring at the ceiling, laying in bed over the weekend.
Sorry, Kate.
Thinking about that one.
Kate will be like, "What is he thinking about?" He'll be thinking about this Amazon island. It'll be really interesting to see if Amazon holds. I think you used 135, and I think that's appropriate. If that holds, you do have this massive island in place, and maybe that was the bottom and signaled by some of these stocks.
You've had other things like McClellan's summation index.
Yeah.
Has moved higher. It's above its April highs.
So we finally broken the sequence of lower highs and lower lows.
Got McClellan's summation index by the end of today, given if this, we're up another pretty, 1% plus move today on the S&P. Yeah. So McClellan's summation index is going to be at year-to-date highs.
So the evidence continues to build that this is a type of bottom worth paying attention to. Still important levels to overcome. I think you pointed out the level in the S&P 500 that was around 4170, 4150. We need to clear that. But based on the things we covered in this podcast, listeners have to be open to the idea that this was some form of
I don't
significant bottom.
Yes, it is. I think we've definitely reached the point now where if you were trying to hold, now this was not us. I mean, we are more incremental increasers and decreasers of exposure. But if I think we're definitely past the point where you can be just, I'm going to sit in cash and hope this rolls over.
Yeah, sit in cash or be short. Like you're getting your. You
need to be, and maybe this is it, and maybe there's a massive gap down Monday. But the evidence we've given so far, or that we've gathered so far, the market as a whole, I don't mean David and I mean, it's pretty solid. And I just wouldn't want to be sitting here in 2 months saying, wow, I really thought that this was going to take one leg lower and we're back at 4,500 on the S&P.
Yeah, and that's why you have to use price, because if you're holding short because of some narrative about GDP and recessions, and I mean, you're getting your butt handed to you. And that's what makes shorting in a bear market so hard, is because you get moves like this that if it does roll back over, fine. But if you get an island reversal on something like Amazon and you get Apple going on at new relative highs, you are fighting against two behemoths to try to short. And all I would say is buyer or short beware.
Yeah.
Until we still have a downtrend in place in a lot of things. So
and we're still below downward sloping moving averages.
Right. And really, the S&P 500 itself, if we're below, and we've talked about it numerous times, the 4165, 4170, it's guilty until proven innocent. And so, yes, we can see the market roll over below here. But when you see things like Apple and Amazon do this, you just have to respect it until those things fail.
It's a train that you cannot fight.
Right. Correct. There's no reason.
Don't fight the Fed. I say don't fight Apple.
Yeah. Why fight Apple? And that's why, if people haven't figured out yet, Ian, Isaac, Newton, McMillan, it's really about waiting for Apple to fail, right? Waiting for the apple to fall.
Gotta let it fall from the tree.
Yeah. And if Apple's not going to do that, then this was just a cyclical correction within a broader bear market. And until Apple fails, that's really what's going on here. When Apple fails on a relative basis, that's when you know the bear market is upon us. Yeah. So with that, we've reached the end of our time. Anything I've missed, Ian, that you want to touch base on before we get out of here?
No, still continues to be constructive. This week is only going to add to the more bullish, short-term bullish evidence.
Right. Exactly right. So I appreciate the Adaptive team. I love your coverage last week. I think I'm excited to hear, I'll be gone next week, but I'm excited to hear you guys talk a little bit about Kevin's CMT3 experience. Now that we know the info, you guys can talk about that even more next week. But other than that, we hope you guys have a wonderful time this weekend. We appreciate you guys listening. As I said before, I will unashamed ask for you guys to like the podcast, give it 5 stars, help us get the word out, because big things are coming down the pipe.
They are. I wish we could.
We cannot say a word, Ian, other than we can wish people as you like to wish them. I'm not going to say it. I'm going to let you say it.
Have a good weekend, everyone.
Love it. Later.